Hello and welcome back to Toolbox Talks on the SiteShed. You are joining us today for part 2 of the series we have titled Finance for Tradies and Contractors. The first episode was titled Being Prepared and Asking the Right Questions. As always, guys, please go back and listen to the previous episodes if you have not, because we do structure these in a way that they all lead into each other. This episode is called The Reality of Interest Rates. So again, go back and check that one out and then dive right into this one. In this episode, we are going to be talking about a lot of the myths behind interest rates and a lot of the fallacies that are associated with them also. It was quite an interesting podcast, so I learned a lot, and I'm sure you guys will too. Do us a favor, if you did learn something out of this, let us know by posting a comment in the show notes. You can do that in the comments section there. Likewise, if you see it on social media, you can also ask your questions there and leave your comments. And if you enjoyed it, please head across to iTunes and leave us a review. It does help in our rankings, and we don't ask for a lot, but that is one thing that we do ask for. So if you could take 2 seconds to do that, we would muchly appreciate it. Okay, that's all. Let's jump in. The SiteShed podcast is made possible because of Tradie Web Guys, creators of beautiful websites designed specifically for tradies and contractors. If you're tired of dealing with web designers that have no idea about your industry, then head across to tradiewebguys.com.au and reach out. Like many companies from all over the place, you'll be very glad you did.
Giving tradies and contractors around the globe the tools to run a modern business. You're listening to Toolbox Talks from the SiteShed. Now here's your host, Matt Jones.
Hello, listeners, and welcome back to Toolbox Talks on the SiteShed podcast. My name is Matt Jones, and you're joining me and my co-host for this series, which we have called Finance for Tradies and Contractors, Mr. Sean Fowler from EquipFin. Sean, welcome back.
Thanks for having me again, Matt. Look forward to it.
No worries. So for the listeners out there, the first episode was being prepared and asking the right questions. And if you have not yet listened to that, I encourage you to go back and check it out before you listen to this one, because as always, we structure these series in a way that the following episode will always lead into the previous. In that episode, we were talking about, basically as an overview, what you guys can do at your end in order to make sure that your credit rating stays intact and that you are not putting the big red cross against it, which typically happens, especially in the approval process with a lot of organizations out there that don't have leverage and don't have options in the space of multiple resources that are available to them, which they can offer to you. So definitely go and check that out, because it is very, very important that you guys are on top of that. And it's something that I've recently learned about. Thank you to Sean. And in this episode, we're going to talk about the reality of interest rates, because interest rates are certainly not black and white when it comes to what your options are and your specific circumstances. So, Sean, thank you once again for joining us.
No worries. Thanks, Matt.
And I think as we spoke about offline, this is one of the very common questions, and probably the first question that people ask you, well, what interest rate can you get me for a car loan or whatever it is? However, the reality is that that's probably not the right question to be asking initially. And it sounds like, to be fair, the question asking should really be done from the mortgage broker itself, not so much from the person that's applying for it. So in this episode, I'm guessing we're going to be talking to anybody that's really applying or in the space of looking to apply for some sort of finance, equipment or vehicle. Well, or any finance really, could be a mortgage even, whatever it is.
Yeah.
So I suppose, why don't we start at the top here? Let's talk about the reality of interest rates, maybe on a macro level, and talk about, I suppose, why they're so varied across the board. And I'm just really curious, I suppose, to hear that, from not so much from somebody who's applying for interest perspective, but then maybe from the perspective of companies that are actually giving the interest or loaning the interest.
Sure. It's a good approach, because there's some fundamentals behind interest rates that dictate what results in an interest rate. And there's an expression where they say rate for risk. Now, if you look up the definition of what is interest, it's called a return on risk. So obviously, the lower the risk, the lower the interest rate. The higher the risk, the higher the interest rate. And that's a pretty stock standard rule of thumb of how interest rates work. So, for example, one of the best assets that you can finance from a risk perspective is a house. House prices are relatively stable. It can't move, so it's easy to repossess. Hence, it's home loans that attract the lowest interest rates. Whereas then you start moving through different asset classes and applicants. So at the moment you start to move away from a house into, say, a more mobile asset, motor vehicle, an excavator, a trailer, because that asset can move, there's a risk that that asset can disappear. A house can never disappear. So
unless it's on the beach at Collaroy.
a few of those are gone. Or if it's in the Midwest of the USA and it gets sucked up by some tornado over there.
Yeah.
Like I said, as a general rule of thumb, they're a stable asset. There's exceptions to every rule. But so as these asset classes become more mobile, that starts to represent a higher risk to the bank for the fact that that asset can disappear. It happens a lot in the fraud space where people fund a certain asset class and next thing you know, it's on a container out to Europe somewhere. So you can't do that with a house. So in these interest rates, the banks have to make allowances for losses and all these things. So the losses are higher on these different asset classes. You move up to, say, a piece of software, which you can fund software, but there's nothing to repossess at all. So if the bank was to lose on that transaction, their loss is quite huge. They lose pretty much everything that's outstanding. There's nothing to repossess. So what people, and then that's the interest rates, how they're affected by asset classes. But then there's the combining factor that the interest rate is then affected by the risk of the customer. So there's two components that are being looked at that dictate what an interest rate is. What is the risk of the asset that's going to be securing the loan? What is the risk of the customer that's applying for the loan?
Yeah.
So if you get I use the doctors. Doctors and lawyers fall into a professional category that quite often get favourable pricing from the banks. And that's because statistically they have low losses in those industries. Therefore, they apply low interest rates because they want those customers on their books. And if a doctor is applying for a house, he's likely going to get a really, really good deal. Now, if you get a startup web design company that wants to finance a bit of software, now you're talking about a startup business for an asset that is not repossessable. You don't get the same interest rate for the two different scenarios. So what people need to understand when they're out shopping around, the first question I quite often get asked when someone comes to me is, what's the interest rate? And I'm like, I don't mean to be arrogant, but how long's a piece of string?
Yeah.
We need to get into understanding what you're buying. We need to understand who you are. And if you turn out you're buying a solid asset and you're a really strong credit client, you'll get a good rate. But if you're buying an asset that presents a different risk and you know there's certain factors about your financial position that present a higher risk, then you can expect to pay a higher rate.
Does that, Sean, tie back to what we spoke about in the last episode in relation to people's individual credit ratings?
Not so much at the moment. It's funny you do ask that because there is and there will be a movement towards the credit scores starting to impact what rate someone is eligible for. They're not quite in that space yet, not quite as intelligent to do that yet. I believe there's certain options out there that are moving towards that. There may even be one or two available, but it's not a mainstream process of, okay, because you might have a credit score of 300, which is relatively low, versus a credit score of 800, which is relatively high. The score in itself is not dictating the rate at the moment. What is probably dictating the rates is some more basic fundamentals about someone. So how long has the business been around for? Do they have equity in property? Do they have any defaults? So it's not so much around the credit score. So it's a more basic fundamentals which tick boxes of credit policies that either make them available for that product, but if they have a default, that might kick them out of a certain product or credit criteria, meaning we may have to put them to a different institution, which may not have such a good rate. So it's not there yet, but watch this space. I imagine that people with high credit scores will start to get better rates.
Yeah, okay, gotcha.
And rightly so.
Yeah, fair enough. Is there such thing as like a business having its own credit history?
Definitely. And this is another good thing to take from this actually is And this sort of delves back to one of the last conversations where we were talking about Equifax and credit histories. Equifax is becoming far more intelligent, and the banks are starting to feed in payment histories of credit cards and personal loans and car loans.
So just for the listeners out there, Sean, just a real quick recap on Equifax.
Equifax is Australia's primary central credit agency. It's had a few name changes over the years as it's been acquired. It was Baycorp, and it went to Vader, and then to Equifax. Equifax is quite a large US company. So I believe it probably serves the same purpose in the US as well. But they're just becoming this information center. So the banks are feeding in information, land titles around property ownership feeds information, and they're just building so much technology around data that it's becoming just this central reporting system. So if we shoot back a couple of years, if you had a car loan, the only way I could find out if you're a good payer was we literally had to call whoever you had that car loan with, and they'd give us a reference over the phone. Not all the banks have moved across to this yet, but going forward, that car loan and your payment history will be represented on the credit file. So no longer do the banks have to make manual calls to get references on you. It's going to sit on your credit file. And this is a tip for listeners as well. When you have a loan, any type of loan, whether it's a personal loan, a car loan, make the payments on time when they're due. We quite often, one of the questions we ask is, have you had finance before? Yes, I have. Did you make all your payments on time? Yes, I made all my payments. I said, well, that's not what I asked. I said, did you make them on time? Oh, look, I missed a couple of days here and there, but I always made it up a couple of days after. The banks won't accept that. That information is now being centrally scored against your central credit score. So they don't, basically, if you're 2 days late, 3 days late, and you do it 4, 5, 6, 7 times, a lot of people think, oh, that's okay, I made the payment, just missed it by a couple of days. The banks don't deem that to be acceptable. So you need to make them on time. It's really crucial, because it's no longer, once upon a time, if you had that impact and the bank made a credit reference call to the bank, the person on the other end of the phone may have looked at it and gone, yeah, it was satisfactory, right? Because it was quite a grey area. It was quite a subjective definition of what that person deemed to be satisfactory. Now, a lot of that information, because it's going to be centrally scored, the person can look at your credit file and go, well, there's his car loan. He missed that payment. He missed that payment. He missed that payment. And they're just going to say unsatisfactory credit history, declined. Yeah, so it's really, 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 really important that people don't think that missing it by 1 or 2 days is acceptable, because the banks are getting smarter and the technology is there that they won't deem that to be acceptable. They don't want to lend money to people that miss their payments.
Yeah.
So, sorry, I digress on that, but it sort of reminded me to let the listeners know the importance of getting that stuff in on time.
Well, I think it's very relevant. Absolutely. So, we interrupt this podcast today to talk to you very quickly about Tradie Web Guy's content creation program. That program has been designed specifically for trade-based organisations as a way that you guys, as trade business owners, can start creating content that enables you to engage better with your customers and your potential customers. It will enable you to build trust and build rapport, because what you're doing is you're investing in educating them. Biggest problem that we see with our customers today is that they're not regularly updating their websites. And that's a problem, because first of all, the search engines are looking for that. And second of all, potential customers are also looking for it. Tradie Web Guy's content creation program has been specifically designed to help you get regular, relevant content on your website consistently every month. We know that it's hard when you're out there on the tools, and we know that sometimes you don't always have the time to be able to do these things yourself. So we're taking it off your hands for you. It's a service that we're offering for you guys. We want to make sure that you're getting this done, because we know how important it is. Anyway, head across to tradiewebguys.com.au/content, fill in the form, and one of our representatives will come back to you.
Now, where were we up to?
Well, no, we were just talking about, I suppose we were talking about the reality of how certain individuals will be subject to different options in the space of interest rates based off their personal history and then business metrics such as how long the business has been running for and how, if there's equity in the business or if there's, to cash flow being able to be proven, that kind of stuff.
Right. Okay. So the first thing I want to address is the ambiguity and the misleadingness of interest rates.
Mm-hmm.
Now, we may likely see a change in this space as a result of the Royal Commission, but at present, commercial finance contracts, and you would have noticed this, Matt, when we saw your paperwork, there's no interest rate.
Mm-hmm.
So when you ask someone, what's the interest rate? Basically, you've got to, unless you have the ability to cross-check that information out of a net present value calculator or something, you're taking his word for it. And the unfortunate thing is there's about 5 ways you can quote an interest rate. There's what's called a flat rate, base rate, an effective rate, a comparison rate, and a customer rate. And they all result in different numbers,
mm-hmm.
even though it's a different, because they calculate differently. So when you say, what is the interest rate? You don't know what they've given you.
Okay.
You say, is that the customer rate? Is that the base rate? Is that a flat rate? And you could be quite often comparing apples with apples. So what happens in my industry? Someone calls me for a quote and they say, what's a rate? Now, what people should be quoting is the customer and the comparison rates, which is the interest rate, which includes all your fees and charges. So you get a true indication. But unfortunately, that doesn't happen. A lot of the people in this industry will quote base rates, which is the cost of funds that they get the loan at. And then they put a margin on, whether it be brokerage or commissions, and then there's fees and charges and all that sort of stuff.
Mm.
So it is all too common a story when someone calls me for a quote and I'll say $600 a month and my interest rate's 5.95. And then they'll say to me, I've got an interest rate of 4.9. I'm like, okay, what's the repayments? Hang on a second. So we've got variables that are exactly the same finance amount, same term, same residual. My repayment's $500 a month and I'm at 5.95. And this guy's quoting 650. He's quoting 4.95. So the difference is I've quoted on a comparison rate. He's quoted on a base rate. And this is why in the other episode I talked about, unless you can cross-check interest rates, don't worry about them because they can be completely misleading. What you need to look at is the total cost of the loan. So that's probably one of the first points because it's the classic mistake. They walk into the dealership and they say, what's the interest rate? Now, you'll unlikely get misquoted a rate from a bank. The banks sort of are a lot more stringent on how they quote and that sort of stuff. So when a bank quotes your rate, it's more than likely going to be accurate. But within the broking world and within the dealer world, quite often they're not always quoting the customer rates. So it's better and it's easier and very easy, manageable for a customer to go, okay, I'm going to throw interest rates out the window. And what I'm going to look at is what is the total cost of this loan? The total the option with the total lowest or the lowest total cost is the one that applies the lowest interest rate, is the cheapest option for you. Now, having said that, interest rates are only one component of the finance process. When we go out and buy a pair of shoes, we don't walk into the shoe shop and go, where's your cheapest pair of shoes? When you walk into to buy, a TV, you don't walk into Harvey Norman and say, where's your cheapest TV? Finance is exactly the same. There's other value propositions or attributes that go into making the decision of which is the best finance solution for me. And it's, a common mistake. People chase the lowest interest rate and they forget about a lot of the other factors that go into making up the value of finance. For example, how much information do I need to apply or to supply to get approved? How fast is the approval? How simple is the paperwork that I'm going to get me? How fast does the payment to the supplier occur? What are the early termination costs? What's the customer service like beyond the commencement of the contract? There's so many other factors that go into our decision making, but we don't make allowances for that in the interest rate because we're so focused on the interest rate.
Right.
And the other thing that customers and listeners need to probably take into account is it, when we talk car and equipment financing in this space for a lot of the tradies, we're buying anything from 5, 10 grand assets, maybe up to 100 for your core trading. There's obviously guys who get heavy earth moving equipment and different types of equipment that sort of go above 100K. But I would say that a large component of finance requirements for the listeners are sub 100K.
Yeah.
Now, a 0.5% difference in interest rate on a $50,000 loan probably equates to around about $10 a month. So
on a how big a loan?
On about 50 grand. So
okay.
In fact, I could run a calculation while I'm actually talking to you to give you that exact figure.
Wow.
But most people, when you highlight that a 0.5% difference equates to this much of a difference in repayment, all of a sudden the interest rates go out the window. They said for $5 a month,
who cares?
There are finance options where you don't need to provide financials. There are finance options with certain funders that if you're in a rush, it can be turned around in a day. And all these other requirements that customers have about speed, simplicity, it starts to now outweigh the importance of the interest rate. Now, the interest rate's still very important. Like, you don't want to be going and paying 12, 13, 14%.
Right.
But if you've got an option where, you've been quoted 5.5%, but you've got to provide 2 years worth of financials, tax returns. I need to get my wife's pay slips. I need to do this. I've got a 3-page application form to fill out. It's going to take 48 hours for approval, blah, blah, blah. Goes on. And then someone turns around and goes, well, for an extra $6 a month, I could have it approved with a 5-minute conversation on the phone and I'll have documents on your table by tomorrow morning.
Yeah.
People start to weigh up convenience and time. If there's a blowout of, $50 a month, $100 a month, that's starting to make a significant impact. That could be a difference of $3,000, $4,000, $5,000. If you're talking about a few $100s over a 5-year period, then it comes down to the value of your time going, great, I don't have to spend much time on this. I'll pay the extra $5 and just move on.
Yeah.
So we've been socially ingrained to ask about interest rates, but the reality is people are asking a question that they don't even understand the answers to.
Right.
So
look, I'm very familiar with that. I mean, we get it just to put you at ease, I suppose. Like, we get a lot of that stuff across vertical. People ring up and they'll say, "Oh, we want Google AdWords," and because they know the term, right? And you go, "Okay, cool. What do you want it for?" And then they'll tell us, and I'm like, "You don't need Google AdWords for that. You might need this, or you might need that." Like, it's keywords. People understand keywords, and they basically ask, I suppose, those questions based off what they think they know.
Yeah. Look, it's a hard one because in business we want to surround ourselves with specialists that we trust, because I've been doing this for 20 years. So a customer, no matter how much I educate them, they're never going to fully understand what I understand about finance and interest rates. My customers just trust the information that I'm giving them. And whether it's an insurance broker, a finance broker, or a mortgage broker, it's a matter about finding the right one that is professional and educated and that you truly trust them. And it's a really hard word to use in business because people abuse trust when it's given, unfortunately. But when you do surround yourselves with people that you trust to help you make those decisions, because they're the specialists, you've got to trust their guidance on that. That you go, okay, and you did that. I mean, I explained to you the situation of the option we went for, and you trusted the guidance, and we just went with it. There are many people that might have gone, "Oh, I'm not happy with that response. I'm going to keep on looking." And then find out after 3 months of searching around that actually the advice or guidance you were given the first time was the right one. And the only way that you can do that is at some point you've got to provide a little bit of trust to the people that are providing that special advice. And so it's a matter of searching, ask for recommendations about who people have used in the past. And it's, because in business, we all need insurance. We should all need finance, even lawyers, accountants. We want to surround ourselves take the plumber. He's awesome at cleaning toilets, plumbing, gas, doing all this sort of stuff. He's not a finance guy. He's not an accountant. He's not an insurance guy. He needs someone that he can go to that specializes in each of these services and go, "Mate, what should I do?
Yeah, yeah.
And if you can't sort of put a little bit of faith in that, you're always going to feel stressed about it. You're going to shop around. You're going to be doing a lot of stuff, and you're wasting time.
Yeah.
But it comes back to you've got to find the right one.
Yeah. Okay. Cool. All right. Brilliant. Well, look, I think that pretty much calls that episode to a close. Unless there's anything you wanted to add.
No. I think the interest rate one was, I think it's just an important thing for people, and sometimes it's a bitter pill to swallow.
Yeah.
To accept that they're not eligible for the lowest interest rate that may be available in the market.
Yeah.
But I think if they understand the fundamentals about how that interest rate decision is made, then they might be more accepting of, okay, I get that. I understand that I can't get 5% because I've got a new business or I've got a default or the asset I am buying has a higher risk attached to it because of resale or whatever. And they can start. So next time they walk into or speak to a broker or speak to a business manager, and the guy goes, oh, you're buying a 2007 Ute and you're a startup business. It's a used asset. My business isn't well established. I don't have a finance history. Be accepting that you're going to cop a slightly higher interest rate because of the variables attached.
Yeah, yeah. No, I think that's good. I think one of the big takeaways for me on that one was, if you can understand the difference between, the interest rates and what at the end of the day it's going to cost you, then it effectively will more or less throw it out the window and make it irrelevant. So it's all about choosing the right solution.
Yeah, and you smack bang, it's a solution. Anyone can quote an interest rate, but it's finding the right solution that has the right contract variables, the right speed, because some people need it in a hurry. There's a whole bunch of variables that go into that it's not a one size fits all situation at all.
Yeah, brilliant. All right, cool. Well, that brings this episode to a close. So thank you once again, listeners, for joining us. Thank you, Sean, for your time.
Thanks, Matt.
And for the listeners out there, just to recap, that was the second episode of the Finance for Tradies and Contractors series that we're conducting. That was the reality of interest rates. The first episode was being prepared and asking the right questions. And you can get to all of those episodes through the siteshed.com. And you can also find it on your podcast listening app of choice. Sean has left behind a cheat sheet as well, which you can access through the siteshed.com on the show notes for all of these episodes within this series. That is the cheat sheet to finding the right finance solution. So I encourage you to get over there and get hold of that. And you can also get access to Sean on those through his details, and we'll post it on that page as well. All right, that wraps us up. So we'll come back and be speaking to you in the third and final episode of this series, which is going to be how to structure your finance. Thank you for listening to another episode of Toolbox Talks. If you're liking what you hear, then you can head across to the siteshed.com, where you can join our community by signing up to our Toolbox Talks. You'll get sent a weekly notification, which is basically a highlight of everything that we've spoken about during that week, along with any other industry news that may be relevant or specific to the trades. If you're enjoying the show, you can head across to iTunes, Stitcher, or SoundCloud, where you can leave us a review. That would be fantastic, and all the reviews get read out in the show. Likewise, if you have any friends or colleagues that you think would benefit from the show and the episodes that we create, then please go ahead and share it with them.